1. Definition. Investing in equity instruments refers to the act of allocating capital to purchase ownership shares in a company. These instruments, typically in the form of common or preferred stocks, represent a stake in the company's equity. As an equity holder, the investor becomes a part owner of the business and may benefit from the company's profits through dividends or capital gains. 2. Importance of equity investment. Equity investment plays a vital role in both personal wealth building and corporate financing. From an investor's perspective, it provides the opportunity to earn higher returns compared to fixed income assets. For companies, issuing equity is a strategic way to raise funds without incurring debt. Key benefits include ownership in potentially high-growth companies, capital appreciation over time, dividend income, depending on the company's policy, liquidity, as most stocks are easily tradable on public exchanges, inflation protection, particularly in long-term investment strategies. 3. Types of equity instruments. A. Common stock. Common stockholders have voting rights in corporate decisions and may receive dividends. They benefit most when the company performs well, but they are also the last to be compensated in case of liquidation. B. Preferred stock. Preferred shares typically offer fixed dividends and have a higher claim on assets than common shares in the event of bankruptcy. However, they usually lack voting rights. C. Convertible securities. These are hybrid instruments, such as convertible bonds or preferred shares, which can be converted into common stock under specific conditions, offering both income and equity upside potential. 4. How equity investments generate returns. There are two main ways investors can profit from equity investments. Capital gains, profit from selling shares at a price higher than the purchase price. Dividends, periodic cash payments distributed from the company's earnings. Well-performing companies often deliver both forms of return, while growth-oriented companies may reinvest profits instead of distributing dividends. 5. Risks of equity investment. Equity investment involves inherent risks that must be considered. Market risk, stock prices fluctuate due to economic, political, or sector-specific events. Business risk, poor company performance can lead to share price depreciation or dividend cuts. Liquidity risk, some stocks may be illiquid, making them difficult to sell without price impact. Emotional risk, investors may make irrational decisions during market volatility. Mitigating these risks requires diversification, informed decision-making, and a clear understanding of investment goals. 6. How to start investing in equities. For new investors, the following steps are recommended. 1. Educate yourself on basic investment principles and financial literacy. 2. Open a brokerage account with a licensed securities firm or use a reliable investment platform. 3. Fund your investment account and research companies of interest. 4. Evaluate stocks using fundamental and technical analysis. 5. Build a diversified portfolio to spread risk. 6. Monitor your investments regularly and stay updated with market news. Long-term success in equity investing relies on consistency, research, and emotional discipline.